Now, Michael Linton's article also walks us through all the different types of commercial loans out there.
Yeah, there's a whole menu of options.
There really are. Let's break them down one by one, starting with what Michael Linton calls the most basic,
Yeah,
traditional bank loans.
right.
What are the pros and cons there?
Well, bank loans can be good because they might have the best interest rates, competitive rates. Michael Linton says we're probably looking at a range of 6.5% to 8.5% this year.
Okay.
But banks are also pretty careful. They're going to want to see a strong credit history, and they really like properties that are already stable, producing consistent income.
So if your property's a little riskier,
Yeah,
a bank loan might be tough to get.
it could be, yeah. The terms are usually in that 5 to 10-year range we talked about, with amortization maybe up to 25 years.
Mm.
And their loan-to-value ratios are usually capped at around 65% to 75%.
All right, makes sense. Then there are SBA loans.
Right, those are backed by the Small Business Administration.
So what are the benefits of going the SBA route?
Well, Michael Linton points out that SBA loans can sometimes have lower down payments, maybe even as low as 10%. And they offer longer terms too, potentially up to 25 years. But there's a catch. You have to actually occupy most of the space yourself.
Oh, so it's not just for any commercial property.
Right, it's primarily for owner-occupied properties.
Yeah.
Like your business needs to be operating out of at least 51% of the space.
Okay, interesting. And what about the different SBA programs?
Well, the two main ones are the 7A loan, which is pretty flexible and can go up to $5 million, and the 504 loan, which is specifically for buying major assets, like the real estate itself.
So if you're buying a building for your business,
Yeah.
the 504 loan might be a good option.
It could be, yeah.
Okay, moving on, we've got CMBS loans, or conduit loans, as they're sometimes called.
Right, those are a bit different.
They are. How so?
So CMDS loans, they're actually bundled together with a bunch of other commercial mortgages and then sold off as bonds to investors.
Okay, so it's not a bank directly lending you the money.
Exactly. One advantage of CMBS loans is that they're often non-recourse.
Okay, that's good for the borrower.
It is. And they usually come with fixed interest rates, typically for terms of 5 to 10 years. Amortization is longer, usually 25 to 30 years.
All right, but they have prepayment penalties, right?
Yeah, that's one thing to watch out for.
You can't just pay the loan off early without paying extra.
Right. And they often have stricter requirements too, like having reserves for things like taxes, insurance, unexpected repairs.